Thank you so much for joining us. Really glad to have you all here. As I was saying earlier, I hope you have a pen and paper because these two guys, we are in for such a treat tonight. We are talking about partnerships for growth. And my idea behind the creation of this webinar is really what happens when the traditional joint venture agreement, two parties, 50% split of the deal no longer works for us. What do we do next? How do we do bigger deals? How do we get more people involved? How do we, raise more funds? So these guys, two of the absolute wealth of information, resources, like these guys really know what they're doing. So I'm really honored to be able to bring you Victor and Phil this evening to share with us their insights and information. So our agenda this evening, quick welcome and introductions because Victor has this fantastic presentation prepared for us. And I want to make sure that we can get through all of it. And then Phil is going to be coming and bringing in his expertise. We can do a quick panelist discussion or question and answers at the end, depending on what time we'll allow. And then I'll do a quick wrap up right at the end of the webinar. We will aim to finish as close to 8:30 as we can make it because I know everybody has things to do. So my name is Elizabeth Kelly. I've been a real estate investor for 17 years now. I've done a number of different investment strategies. I've got 8 years as an elite trainer for Rich Dad and 4 years as a coach and mentor. My specialty as a coach is really helping people build a real estate business. So it's not about one specific strategy. It's about all the systems, tools, processes, and support that you need around you to transition into a full-time real estate investor. And we have Victor with us. Victor is the author of a book called Magnetic Capital. He's also the host of a daily Real Estate Espresso podcast. And then he is a principal with Y Street Capital. Tons of accolades, lots of experience. And Victor and I were just catching up. Victor, you were a Rich Dad student just before I was, and I think within months, if not just a few weeks. Yep. Victor was a vice president of engineering and has a ton of information and knowledge that has truly been beneficial in terms of helping him build a very large scale investment portfolio. We also have the privilege of being joined by Phil Reimer, and he leads the Ottawa office of Denton's Real Estate, Project Development, and Banking and Finance. So that's an awful lot of experience and knowledge, and we're really glad you could join us tonight, Phil. Over the past 3 decades, he has distinguished himself as one of the country's most valuable lawyers and respected deal makers in all areas of commercial real estate and infrastructure projects. So we really have, one of the OGs here with us tonight. Phil has been recognized repeatedly as a trailblazer in all the areas in which he practices, continues to win industry accolades, being named Best Lawyer's Lawyer of the Year in Banking and Finance. That's pretty amazing. In 2014, 17, 19, and in Aboriginal Law, Ottawa in 2020. So thank you, gentlemen, for joining us. I'm just going to do a quick housekeeping and then I'm going to hand it over to you. Just a reminder to everyone for our webinars together, there's 2 ways that you can interact with us this evening. So the first one is the chat box. That's what pretty much everybody is used to. Please make sure you click the drop down there. It's going to default to hosts and panelists, but you want to have the check mark next to everyone so that when you're saying things, everybody who is here this evening can see what you're saying. So interact, comment, acknowledge, whatever you would like to say in the chat. That's for the ongoing dialogue. If you have a specific question for the gentlemen who are presenting tonight, please do put it in the Q&A. And the reason for that is because if you put your questions in the chat, I promise they will be lost by the time we reach the end for the Q&A session. Whereas when you put them in the Q&A, then we can revisit them at the end of the webinar. And if they haven't been answered, the guys will be happy to do that. There we go. Thank you again, everyone. I may shut my my video camera off so I'm not distracting everyone. And thank you, Victor and Phil, for joining us this evening. Victor, it's over to you.
Thank you, Elizabeth. Well, great to be here. It's a thrill to be here tonight and to share with you some thoughts on how to raise money. And this is something that I learned early on in my career. I started out raising capital in the tech industry. And it's not the typical career path into the world of real estate investing, but it was a very useful path. And I can tell you that raising capital for something like a real estate project is a whole lot easier than just raising money for an idea. Because oftentimes you're raising money in an area where the market's not proven. Phil can tell you very well, he's very close to the principles of Shopify. These folks were trailblazers. They did something that hadn't been done before. And the landscape is littered with people that have tried to do something very similar and failed. The world of real estate investing is a whole lot easier. And I exited the world of tech. I was actually a microprocessor designer, and exited that world in around 2009. I was on my 18th trip to Tokyo, building a new cellular network for the number 4 carrier in Japan, and just decided it was nuts. I was, taking these 13-hour flights to Narita Airport and just not spending any time with my family. So literally quit my job as VP of engineering. But I took with me what I learned in the world of real estate investing, in the world of technology. And then I reapplied that in the world of real estate investing. And that was the impetus for writing the book, because what I discovered is in the world of tech, I actually raised a lot of money. And when I went into the world of real estate investing, I had to relearn that process all over again. And when I did, I realized it was almost exactly the same. And it was like, oh, wow, this is the same. And when you follow these basic rules that we're going to talk about tonight, in terms of the psychology of raising capital, you'll discover that raising money is remarkably easy if you obey the principles. And then we're going to talk about the legalities of it, which is why Phil is here, because I see so many people doing it wrong. We've seen some very high profile blow-ups in the news lately, and I just don't want anybody on this webinar to be one of those folks in the news. I just don't. So we're going to put a little bit of the fear of God or the fear of the Ontario Securities Commission in you so that you really understand what it takes to do this properly. As Elizabeth mentioned, I'm also the host of the Real Estate Espresso Podcast, a daily show 7 days a week. So I'd love to have you as a listener. We're on 20 different platforms. What is it that I do? I build stuff all over Canada and the US, mostly US. We're about 80% US development. Our current pipeline is about 600 units of vertical construction, about 2,000 acres of land development in our current pipeline. We do everything from multifamily, commercial, self-storage, senior housing, what else? Land development, residential subdivisions, townhouses, lots of stuff. This past year, we just completed an assisted living project that, lo and behold, won the Senior Housing News National Architecture Design Award across the United States. So kind of cool to get that kind of level of national recognition. We obviously don't go into this business to win awards, but when you do, it's kind of cool. And the reason we won, I believe, is because we just didn't design a building, we designed a full product. And that flows right through to the service. This project, we raised the capital for it. It's in its leasing stage right now, and it'll be converting to permanent financing in June. Just like you, if you're an active investor, I started with something very straightforward, a single apartment. This was a 1-bedroom condo within a few blocks of Parliament here in Ottawa, where I live. And I really took a business approach to it. I simply said, well, we've got a lot of people coming into Ottawa looking for a place to stay on a medium-term basis long before Airbnb existed, where they were looking for a furnished unit. They couldn't afford a suite hotel on their housing allowance, whether they were parliamentary staff, embassy staff, or military officers, but they needed a place that would fit within their housing allowance. And so I simply designed products that would fit with that, just taking a very simple business approach. And that was a good business. It wasn't a great business. I got out of it, but it was a good business. So that's a little bit about my background. What we're going to jump into now is talk a little bit about how to raise money. And let's start with, when we're raising money, we're really talking about, you've heard this phrase if you've taken any real estate education, OPM, other people's money. That could apply to banks. That's OPM, that's other people's money. But that's usually the easy part. The hard part is the equity side of the equation. And this is where we often get into trouble, where we often get into hot water. So, Phil, why don't we start with what is a security? Because this is such a key question that I think a lot of folks get tripped up.
Yeah, a good point, Victor. And frankly, I was going to take notes myself. You're doing such a good job so far. So, yeah, a security is a concept that is, well, first of all, in Ontario, it's governed by the Ontario Securities Commission, but whatever Securities Commission applies in the jurisdiction you're in will prevail. But basic principle is the same, and it's basically an interest that is reflected typically on a paper document of an interest in some sort of property. And so it could be an agreement, it could be a share certificate, but it's very broad because it's intended to be reflective of having an interest in something else. Now, why this is so important is the marketing of securities are regulated by the Securities Commission, and the most important one is typically to market a securities or to trade in securities, it has to have a prospectus filed with the applicable Securities Commission. So some of the securities that are highlighted on the schedule on this chart are all reflective of securities. Let's just, if you could go back to that chart a second, we'll just deal with them very quickly. Publicly traded company, I mean, you mentioned Shopify, BCE, anyone on any of the exchanges, those are their share certificates are securities. Shares in a private company, again, although not traded on a public security, it's viewed as a security as far as the Securities Commission is concerned. An option contract, option to purchase, option to, these would be, if they're being traded for their value, they would qualify as securities as well. A loan secured by a mortgage, if it's intended to be traded, it can qualify as a security. So the thing is it's something that is expected to be traded, or in other words, conveyed to reflect an interest. You're basically going to fall into the security situation, and you got to get exempt from that. As a broad way, securities break into four broad categories. One is an interest in equity. Second is an interest in debt. Third is what we call a hybrid security, and it's usually like got a conversion option. In other words, it can start like, this is very popular in tech startups. You invest under as a debt instrument, but at a certain state, at a certain event or a certain time, it converts to equity. So that too would be a security. And the fourth is what they call a derivative security, which is really outside the scope of this. This is really very, very unique. But that's to give you in short, the message is anytime you're trading with anything in paper reflecting an interest in property that you're trading for value, you're basically going to be looking at security. One final comment, it used to be thought that if you're trading in real estate is not a security. And so quite often initially, promoters were saying we're exempt from the Securities Act because we're dealing with an interest in real estate, not trading securities. In fact, the Securities Act was clarified. Well, frankly, the case law confirmed it, and the Securities Act was subsequently amended to clearly reflect, selling an interest in real estate would be viewed as securities as well. Okay. Well, as you pointed out, it's an incredibly long, detailed list, and again, it's the number one way to protect the public from promoters that would be selling anything over the without any controls in place. And that's why that concept of security is so broad and so important to comply with.
This is one that I put in here because it's not a legal test, but there is a case law in the United States called Howie that speaks about this. And what I've discovered is that almost universally, when you apply this test, chances are good that you might be trading in securities. Would you agree with that?
Absolutely. And the reason being is because it's the active party we would look at from the securities as the promoter. the one that's going out to raise the money and to basically carry on the business undertaking, and the passive investor is investing in that opportunity. And how's the promoter enticing the passive investor coming in? He's selling him an interest in that. So that's exactly, chances are good, that's a very good practical observation, that you're likely dealing with a security. And then you got to see if you fall into an exemption. Sorry. Okay.
No, that's perfect.
Yeah.
Now, Phil, one of the things that we often hear, and I know there's a lot of real estate companies out there teaching this, real estate education companies out there teaching this notion that, you do the work, you get a joint venture partner, they bring all the money, and you're good to go. Just do a joint venture. How do you feel about that?
Again, absolutely not. And that's how, because the joint venture or co-tenancy interest, joint venture and co-tenancy are used interchangeably at law. And what they're basically saying in that concept is you're getting an interest in property. And that was how they tried to distinguish it from being a security. Now, first of all, that was nothing more than trying to be, creative to get around the Securities Act, which just does not work. But secondly, more importantly, very rarely should you invest in a joint venture structure, because as a passive investor, you get a lot more protection by limited partnerships. So, and don't get me wrong, there are occasions where you have to use a JV or a co-tenancy arrangement, but in the transactions that you would generally see on the street, they should be structured as limited partnerships only to protect you, because one of the unique things about a limited partnership is by statute, a limited partner is limited to his recourse to his investment, similar to like a shareholder who invests in a corporation. Unless he's, just by being a limited partner, his interest, his exposure is limited to his limited partnership contribution, nothing more. In a joint venture, it's a matter of contract. And frankly, a co-tenant, it can be, there's no statutory protection. In other words, it could happen, you could be protected if the co-tenancy agreement or the joint venture agreement specifies that. But even that has limitations at law, because if a third party enters into a co-tenancy, a contract with the co-tenants, and the co-tenancy agreement doesn't limit the co-tenant to his obligations, that co-tenant could be responsible for the full amount and then have to seek contribution from the other co-tenants. So very much a joint venture is not the structure to work with. Again, there are unique reasons where sometimes it's done that way, but that would require special advice and special consideration to make certain all these and other issues are addressed. Does that help you, Victor, on that point?
Yeah, perfect.
Okay.
Let's talk about the three types of securities.
Okay.
You touched on registered securities like shares and Shopify.
Yeah, and shares and debt and as I mentioned, convertible securities. And basically what it means is any security that is properly being promoted or marketed, to be registered, it's going to have a prospectus. What's a prospectus? A prospectus is an extensive legal document filed with the Securities Commission and allowing for the marketing of the securities, in the proper way. An exemption are unique permitted exemptions where where the promoter does not have to file a prospectus, but yet is entitled to market that security. And this is the area where you would generally see these type of real estate promoters operate in. Illegal is basically anything else. If you're not an exempt, you're into illegal, and there's a lot of implications, both regulatory as well as civil law implications for dealing with the illegal securities. Frankly, quite often it's even criminal in content. But for the most part, we're going to be focusing more on these exempt. And from a practical level, there's certain exempt ones that would apply, I believe, to basically 90% of the people on this call. And so we can pursue more. Well, thanks, Victor, for bringing up the new slide about the exemption. If I'm talking too much, let me know, Victor.
No, this is
feel
perfect.
free. Oh, okay.
Perfect.
So yeah, one or more of exemptions from registration. So you will hear, and the most common one is called the accredited investor exemption. And what that basically means is that the investor is accredited or recognized by the Securities Commission to be well enough informed and well enough financially capable to assume the risk of investing in a project. And so it's allowed it. So this is the accredited investor exemption, and the most common are where an individual over the past 2 years and the current year is making before income tax, income in excess of 200,000. If it's a combined, it's 300,000, like two spouses together combined, that's 300,000. Or if they have financial capability or financial net worth of over $1 million. Those are permitted accredited exempt accreditors. So when a promoter comes out and says, I'm offering you to participate, he's likely needs you to be deemed to be an accredited investor in order to not have to file a prospectus and to be able to have you involved in to solicit you to be an investor in a project. Okay, so that's the accredited investor exemption we just talked about. Another one is offering memorandum, which is highly irregular for the deals we're dealing with. An offering memorandum is a short form of a prospectus. In other words, there's still a filing, but the filing that's done with the Securities Commission is an OM, or offering memorandum, as opposed to prospectus. Far cheaper and time efficient approach. But again, doubtful that the offering memorandums are offered, but as well. But again, in the deals that we're dealing with right now, where we're talking about are more in the accredited investor exemption. Crowdfunding is really permitted under the Securities Act, and I'll be honest, this is more tech focused. I'm aware of it. I really don't know much about it. And then the small issuer exemption, I'm assuming you're pertaining to, it's where it's family and friends that are deemed not to be the public. So if if a child or a parent, like in my case, I tried once to do something, and I had my parents come in as investors with me. Bad decision they made. But again, where there's such a tight relationship, you're deemed to be outside the public, and it's really a smaller issue, a small issuer exemption, because of the close proximity between the promoter, the close relationship between the promoter and the investor. And that is that's a very sensitive area, because where is the bright line? There's no clear bright line. I mean, a first cousin, it could be it could fall within the smaller issuer exemption, in one scenario, but not in the other. It's truly a matter of fact. So you've got to be very careful on that. Okay.
So Phil, what happens when you've got a property in one jurisdiction? You might have investors in that same jurisdiction, but then investors in other parts of Canada as well, or maybe even outside the country.
Yeah, and that's a real problem, because where the investor is being marketed is the critical criteria. So and that's why in prospectus filings, you'll see, or offering memorandums, you'll see that they will file it in multiple jurisdictions, because they're going to go into those jurisdictions to look for investors. So if you're soliciting an investor in any jurisdiction, you've got to make certain you're compliant with the securities laws of that jurisdiction. And so even if the property is in Alberta, if you're raising money in Alberta, in Ontario for that Alberta project, or like, for example, where we're doing a deal right now for an investment in Quebec involving Ontario investors, the offering is made compliant with Ontario law because all the investors are in Ontario, ironically.
Perfect. So what happens when you run out of money and you need to pay, let's say, a preferred return to your existing investors? How do you go get additional money and stay on the right side of the law?
Yeah. Wow. It's funny. Well, I mean, a Ponzi scheme is really not my specialty. I just
hopefully it's none of our specialty.
Yeah, exactly. I just read stories about it, and that's as far as it goes. But the key is there's legitimate ways to leverage the property or the asset. I mean, you can get senior financing, you can get junior financing. We can get into what's called a secondary offering, which is like basically reselling existing equity interests to other parties. But the truth is, when the project is being proposed or promoted to the investor, it should reflect, particularly in a development play, it should reflect a detailed project of a detailed cash flow to show the project costs and where the project revenue streams are. Typically, there's an ability for the promoter to go out to raise more money if necessary. It's usually the obligation to do it. There are many situations that can arise. It's possible to go into to do a secondary financing where it's not on such good terms, what's called a down round. So new investors are coming in on preferred terms. If the secondary offering is because the value of the asset has improved significantly, it's an up round. So new investors will pay more. There can be a liquidity event where the existing investors may get repaid some or all of their money. That's called a liquidity event. And otherwise, Victor, I'm trying to keep it more focused. Like we can talk more about that when we talk about waterfalls, and I suspect that I think you raised later on in your deck.
Sure. So a lot of people will often go out, they'll consult their lawyer, and sometimes lawyers, I know it's shocking to hear this, sometimes lawyers practice outside their lane, and the client thinks that they're well protected, and often they're not.
Yeah. For example, as you can see, I'm a real estate lawyer. I'm not a securities lawyer. In fact, we have a row of security lawyers right beside me that all they do is work with the Securities Act, and again, the limited information I have on securities law is relevant for my area of law. Obviously, from time to time, creative issues come up, and obviously we'll bring in a securities lawyer. When we're working for a proponent on a project to raise money, I generally will bring in a securities lawyer to assist in that, as well as a corporate lawyer to help us structure the entity. Typically, as I mentioned earlier, is the formation of a limited partnership. So we will bring in the lawyers as we need them on the project. Obviously, we try to avoid having any criminal lawyers involved with anything. In fact, we don't practice criminal law, but from time to time, we've seen that been referred. But again, in the real estate promotion business, it's not uncommon to see a real estate lawyer involved, a corporate lawyer, and a securities lawyer. Different degrees of involvement depending on the exact who the proponent is and the type of project we're dealing with.
Awesome. Well, hopefully this has put the fear of at least something in you, that there's just an awful lot to know. And at this point, we'll transition to talking a little bit. Once you figured out that, boy, I don't know everything that I need to know. I need to consult the right team of lawyers in order to put together a project. It's almost never just one lawyer. I mean, I'm always in my own development projects working with multiple lawyers.
Yeah.
Now, how do you actually go about raising money? And this was what I learned. And this is really the core of the book, Magnetic Capital. This is what I learned along the way, that when you obey these 5 principles, raising money is remarkably easy. And it starts with relationship, trust, results. What's your track record? You got to have a compelling opportunity, and you have to have perfect alignment between the goals for the money and the goals for your project. And if you do all 5 of these things, raising money is remarkably easy. So let's go into these in a little bit more detail and talk about what that means. Most of the time, people will not part with hundreds of thousands or millions of their hard-earned life savings with folks they don't know. And yet somehow we forget that. And so you really want to focus on relationship building. We often see in business, people go into this zone, I call it creepy. And if I use a dating analogy, you'll understand it instantly. Because, let's say a romantic relationship follows a regular progression. It starts out with, people eye each other across the room, and then they go out on a date, and then, maybe go see a show, and a long way down the road, they may get married and start a family together. But if you skip steps, even a couple of steps in that process, you go from a natural relationship progression to creepy in a heartbeat. And so you don't want to go to creepy, but yet sometimes in business, we see that. People will connect with you on social media, and then before they even have had a conversation with you, they say, "Can you like my page?" Or they're soliciting you for something. Well, I'm sorry, that's creepy. And it really starts with a relationship. You don't want to be out there using people. Nobody wants to be used. So if you're connecting with people, if you are networking, connecting to get as many business cards as you can at an event, or if you're just asking a couple of questions and saying, "Oh no, that person doesn't have any capital for me," and move on to the next, that's using people. Nobody likes to be used. And in particular, people with a lot of capital, they have their guard up. They don't want to be used any more than you do. And they know that some people out there want to have a relationship with them for one reason only, and that's because they have money. So it really starts with a relationship. You can get different things from different relationships. You might get a friendship. You might get introductions. You might get access to opportunity. You might get advice. You might get some capital. You might get credibility. You can get all kinds of different things from different relationships, and you want to be able to contribute to those relationships as well. A lot of people say to me, "Well, Victor, I don't know people with money. How do I meet people with money?" Well, find out what their interests are. Maybe find out who's in their orbit, who's in their inner circle. Oftentimes, if you're trying to connect with someone who might be a big brand, don't go after the big brand directly. Try and develop relationships with folks that are in that person's inner circle. They'll be more accessible. And you want to connect with them on a genuine level. You might go, for example, I go to charity auctions. You often run into people with capital at charity auctions. But I don't go there just to meet people and to raise capital. I go there to develop relationships on things that are of mutual interest. Which then brings the question, Phil, let's talk a little bit about solicitation.
Yeah.
Now, there are certain exemptions, in particular in the United States, where solicitation is permitted. I'm thinking specifically of a 506C for accredited investors. That is permitted. The crowdfunding exemption allows for solicitation. In the States, they talk about this thing called a substantive pre-existing relationship. Talk a little bit about your thoughts on when is solicitation and when is it not, and what's allowed.
Yeah, this is a very sensitive area. First of all, a couple of comments here. First of all, as a promoter, you're going to have to have a relationship, and frankly, a commitment into the project, what we call sponsorship. In other words, you as the promoter are also co-investing in the deal. Obviously, the more established you get, the less there is. So sponsorship is critical in any type of solicitation. And solicitation, really, we look at that orbit of the degree of the relationship that you have as a promoter with the individual. In other words, not going out to just the public. You know, there is the accredited investor, but how you propose the solicitation on your smaller projects, frankly, is developed through relationships, pre-existing relationships. I mean, you know, there are other ways around it, but you know, they would be prohibitive from the costs, like you know, a market exempt dealer, just way outside the scope. So. I mean, Victor, I'm going to turn to you on that point, because solicitation is really something that lawyers stay away from. I'm talking about in general terms from what we see, that there's sponsorship is a critical component. And usually at the earlier stages, there's an existing relationship with the investors. But Victor, maybe you could add more on that, because again, yeah.
Yeah, we really try and stay away from even advertising. I know in particular in the United States, they speak about the, you know, what is an offering. So, you know, sometimes people put a disclaimer saying this is not an offering for securities, but then they also speak about what's called conditioning the market, which means that if you're out there just saying, oh, I've got an exciting new project coming up, that too, that kind of conditioning the market could be viewed, in this case, by the U.S. SEC, Securities and Exchange Commission, as getting into that gray zone of solicitation. Now, they have different exemptions in the states. They have exemptions where you are allowed to solicit, like the 506C for accredited, but there's also a 506B for non-accredited, and that one you are not allowed to solicit. So you can blow your exemption by soliciting, for example, and put yourself foul of the Exchange Commission simply by virtue of having solicited. So, you know, we're very careful. You know, most of what we do these days in the States is almost all 506C, because we just don't want to get into trouble. It limits our investor pool significantly, but it's part of the price of doing business. So those are thoughts on relationship. Number 2 is trust. This is the second of the 5 principles. And this is more than just, are you dealing with someone who's honest? It's a whole psychological contract. It's questions like, can I, as the investor, trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you to communicate in an open and transparent way? Can I trust you to hire the right people? Can I trust you with small commitments? Can I trust you with my money? And on and on and on and on. And if any of these are missing, then it starts to break down that trust. And of course, trust is built over time, and it can be shattered in a nanosecond. So this is something we have to be mindful of, that it's something to be built and preserved, and it can be fragile. There's a very good book. Many of you might have heard of an author by the name of Stephen Covey. He's famous for a book called The 7 Habits of Highly Effective People. Well, his son wrote a book called The Speed of Trust. It's by Stephen M.R. Covey. You might think it's Stephen Covey. It's his son that wrote it. And it's a fabulous, fabulous book. And that's one book, by the way, you read that book will change your life. It will change the way you view that psychological contract of trust. And part of the hint is in the title, because when that trust exists, decisions happen quickly. When the trust is absent, that's when people say, oh, I don't know, we need maybe another 2-3 weeks to do due diligence. Then you know that trust hasn't been established yet. Or maybe they're just institutional investors and they got to go through the process anyway. But most of the time, if someone is looking to invest in your project, if there's trust, they'll make decisions quickly. So check out The Speed of Trust. It's a great book. Connected with that is principle number 3, track record. What are your results? Show me that you know how to be successful. Show me how to know how to make money. What have you done if you lost money? Did you make it right? How did you handle it? And track record is one of those things that, especially if you're starting out, you're saying, well, how can I raise any money if I don't have any track record? And how can I get a track record if I can't raise any money? It's a circular argument. I'm stuck. Well, if you're collaborating with your partner on your grade 5 math test, that's called cheating. But this is a team sport. So the name of the game here is, if you don't have that track record yourself, well, then align yourself with someone who does. This is a team sport. Projects that we do here in Canada, one of our partners has built most of Ottawa's tallest towers. One of my partners in the United States has built over 10,000 apartments so far in his career. We're doing multiple projects together. So when we were approached by a developer in a shopping center owner in Denver to build a high-rise tower on top of one of his shopping centers, and asked about our track record, well, I pushed Bob to the front because he's built 10,000 apartments. I feel perfectly confident and competent to go build that project. But compared to Bob's track record, my track record looks like a rounding error. So I push Bob to the front, and it's perfectly legitimate. We work together, we talk every day, and I can get to borrow some of his credibility by virtue of the fact that we are a team. So it doesn't mean you have to go work for someone else for a decade. It might be for a year or two. It might be you bring someone in as a co-GP, as a co-general partner in one of your projects. And that's part of how you build that track record, is by partnering with some of the right people. Number 4, and this is where most people start, you got to have a compelling opportunity. Most people think it's all about the deal. I got a deal. You want a deal? I got a deal. And it's almost never about the deal. But you do have to have a compelling opportunity. Now, the question is, what is compelling? This is a little bit like asking, is this image on the magazine cover beautiful? Well, it could be. It's a little bit in the eye of the beholder. For one person, that beauty might be a medical office building at an 8% cap rate with 90% occupancy. For someone else, it might be a self-storage facility at 50% occupancy and below market rents. It's a little bit in the eye of the beholder. What is that definition of beauty? But most of the time, and you've probably heard this before, that when you have something that's a great deal, the money will appear. Well, that's kind of sort of true, but you got to be looking in the right place. If you're looking for tuna in a freshwater pond, you're not going to find it. So you got to be looking in the right place for that money, which means getting clear on that definition of beauty and figuring out who sees that particular project as beautiful. For us, what that means is we're big believers in economic fundamentals. We are big believers in obeying the laws of supply and demand. Some people will go into a town like Detroit and see a house for $30,000 and consider that a bargain. I don't, because Detroit's a shrinking city. Nothing wrong with Detroit, but its population used to be 1.4 million. Today it's just about 700,000. It's a shrinking city. There's a reason why you can buy properties for less than the cost of construction. It's because people are leaving. I want to see the opposite. I want to see that influx of population. I want to see that. I want to see a long-standing mismatch between demand and supply. I want to see way more demand. So we're in a bunch of different markets. We're in Spokane, Washington, Colorado Springs, Denver, where else? Lake Charles, Louisiana, Boise, Philadelphia, Central Florida. We're in a number of different markets. We're in Houston and Dallas with a lot of these development projects. I'm going to share with you a couple of examples. Boise is a market. It's one of the fastest growing cities in the kind of Pacific Northwest region. A lot of people moving from the coastal regions that are very expensive coastal markets where, Boise's in a valley. It's a lot of outdoors. And like many markets in America, there's a shortage of supply. There's a lot of growth. This is one project. We have several projects in Boise that we're doing. This is one that we're doing right now. In fact, I realized after I put this in, the zoning meeting is tonight. It'll be about an hour after this presentation. I'll have another lengthy Zoom evening tonight in the planning and zoning meeting. This is a 151 unit residential subdivision that we're building. And we bought the dirt for 3.1 million. We already have a builder, a national home builder out of California that is buying the papered lots from us. Once they're fully entitled, they'll write us a check for 7.8. So that's a reasonable payday for a year and a bit worth of work. We don't have to put a shovel in the ground, but we're basically taking it through the entire design and entitlement process. Now, we had originally planned to take this further in the process, but they just wanted to take it and move it forward. They didn't want the risk of the entitlement, but they were willing to take it once it was entitled and willing to pay a decent premium for it. These are the kinds of projects that we do. In this particular instance, we did it as a tenant in common structure, which means there's multiple owners on title. And part of the reason we did that is because of a tax rule in the United States. Now, we only had two investors on this project, and we knew them, and we felt that it was, they were close enough that we didn't actually have to do an offering memorandum. In the States, there's this thing called a 1031 tax sheltered exchange, which means that if you take profit from a sale of real estate, you can go and exchange it for another piece of real estate and shelter the capital gains tax. But if if you are all shareholders in a common entity, we would then need to go and invest. If we wanted to do a 1031 exchange, we'd have to go and invest together in the next project. Whereas with a tenant in common structure, we can go our separate ways, and we could do 3 or 4 different 1031 exchanges on different properties, each with their own respective shares. Now, there are risks and drawbacks to the tenant in common structure. The first is that everyone, like Phil mentioned, everyone has to sign, which means you could have a partner in here that only has a 5% share, but they effectively hold a veto by virtue of withholding signature. Phil, any thoughts on the TIC structure?
Yeah, no, look, there are times where you have to divert off the LPA. Even in a limited partnership, you've got to look at the limited partnership agreement because there are certain criteria. Now, a basic principle in limited partnerships is limited partner cannot be a controlling party, cannot be participant in a control. Otherwise, he loses his status as a limited partner and he becomes a full partner. So it's very common, as I mentioned at the beginning, co-tenancy agreements are used in unique situations. In Canada, for example, the time we use them is certain pension funds. It cannot enter into limited partnerships because of the Income Tax Act with the pension fund with other investors that are not what's called 142 compliant in the Income Tax Act. So and this is all big ticket stuff. The reason we push towards limited partnerships is there's statutory protection built in there. But that doesn't mean, as you said, sophisticated investors sitting down, negotiating a co-tenancy agreement to address all issues for a unique transaction, that they cannot address these issues. But as you mentioned, this co-tenancy agreement, one or more of the co-tenants may be actively involved in the deal. So, again, he's not going to be a limited partner. Two, that element of trust is the relationship is so well developed that they're ready to accept these additional situations. This is totally different from a scenario where an individual is looking to invest in a limited partnership where he's truly a passive investor, doesn't have that sophisticated experience or commitment to be that actively involved in the development, but still, from the due diligence, sees the promoter to be, a strong, well-known developer that he wishes to co-invest in as an accredited investor. So hope that helps explain it.
Yes.
But to see that distinction.
Showing another example of another project. This is in a town called Lake Charles, Louisiana, which is certainly not a household name. They don't have an NFL football team or anything like that. But in the world of oil and gas, this town is very well known. And if you've been following at all what's happening geopolitically right now, this this thing called natural gas is a very hot commodity, especially in Germany right now. And unfortunately, they're having to buy it from Russia. The reason this town exists is because it's at the epicenter of a network of natural gas pipelines. And with the explosion of production in the United States, of domestic production, there is actually a surplus of natural gas in the US. Now, natural gas is a pain in the you-know-what to work with. It's not easy to transport. So you got to put it in pipelines, or you have to compress it 600 to 1 and liquefy it, supercool it, which is not that's not something you do in your backyard. This town has, there's one of really two places that do a lot of liquefaction. Is Lake Charles and Corpus Christi are probably the two biggest. And to give you a sense for what this means, today you can buy natural gas in the United States between, let's say, $4.50 and $5 per million BTU. That's the measure that's used of that unit of energy. So between $4.50 and $5. That same million BTU sold in Europe today is pricing around $35. It's a huge, huge difference, almost 10x. And it costs you about $1.50 per million BTU to compress it and liquefy it, put it on a ship and send it across the Atlantic. So the profit margins are insane. Since the widening of the Panama Canal, you can now have access to all the markets in Asia, Vietnam, Thailand, India. It's a big deal. Today, 100% of the liquefaction capacity in the United States is being consumed. They're exporting as much as they can. Whatever capacity exists is fully utilized, and they're only able to export about 10% of the domestic production. So there's a lot of multi-billion-dollar LNG plants going into this town of a couple 100,000 people. We're talking between 80 to 100 billion dollars of investment over the course of the next couple of years. Let's say the next 5 to 7 years. And that's a huge amount of investment for any town, let alone a town of a couple 100,000. So they need everything. So that's why we're there. We built an assisted living facility there last year. And this is a project that we're breaking ground on this year called South Lake Village, which is a 240 unit apartment complex. It's immediately next door to the assisted living facility. We just about completed the capital raise on this. And we already have the general contractor identified. This project is pretty much shovel ready. We have full construction drawings. We're pretty much ready to go. In terms of the structure, we use an entity in the US. It is a little bit more complex structure. We have a limited partnership and an LLC involved, a limited liability company, which is set up as a partnership. It is set up as a flow-through entity, much like a limited partnership. And we structured this with a waterfall. And what is a waterfall? It means there is a precedence, an order precedence for how money comes out. So, of course, the first thing that happens is, rent comes in, then you pay your expenses, you pay your debt service to your lender, then you talk about who gets paid next. We get paid our developer fees. The investors get paid their preferred return, which in this case is 7%. Then there would be a return of capital to the investors, usually in our case through a refinance, and then a profit split following that. So there's this waterfall, and this is all described both in the offering memorandum and in the executive summary. We use a structure in the US called a 506C, which is an exempt market offering, where when you register this at the federal level, you also get all of the state level exemptions as well. So you don't have to worry about complying with 52 different states. You get all of that with just the one filing, which is a nice thing about that particular exemption. Phil, anything you want to add about Ontario?
No, you hit it on the head. The waterfall, which is really the distributions, is a critical component of any structure, of any investment. This is the return. Basically, at a very simple level, the waterfall takes into account all revenues, whatever the source. It could be rents, it could be insurance proceeds, it could be other unique features, that revenue streams that come into the deal. They're all caught into the waterfall. then all expenses of the limited partnership are paid. Now, as Victor pointed out, developer fees. Typically, we see in our structures where a related party may provide either management and or development services, and that is structured as a fee. Because again, this is a fee that a related party is charging to the limited partnership. It's disclosed in the limited partnership agreement as a related party contract, and there are protections in there for performance and for solvency. And that would be a fee that, again, is pre-negotiated upfront, and that gets paid. Sometimes that fee might be just reimbursement for lights out and the profit, for pure overhead costs, and the profit component could be delayed at a later date. But in short, the fees are looked as another expense, obviously, to a related party. The preferred return is notionally a return made to the investors for putting up their money, and that is the first return of the profit, and it's usually to reimburse them for the capital that they invested. It could be sometimes there's no preferred return in a very investor friendly deck, but in a very very proponent friendly deck, like all he has to do is pay back the capital without paying an interest component. But in an investor preferred return, there will be a rate of return that would be higher than market. After the capital has been paid out to the passive investors, really what's left but the profits. And typically the profits could be a sliding scale profit, because the better the proponent, and usually his interest is reflected in the general partner type of interest, he gets a greater share of the pie because he's being rewarded for success. And there are different thresholds, but all that to say, these are the key factors to be reviewed. But again, each deal is reflective of the business terms that you're dealing with. How sophisticated is the limited partner, is the general partner proponent, his success factor, his sponsorship commitment. The more risk adverse it is to the limited partner, the better the return for the general partner typically. And that's just reality of any commercial transaction.
Super. This is a project we're doing in Ottawa. Phil and his team, Jason Trainer, the securities lawyers and corporate lawyers at Denton's, were very active in helping us put this particular deal together. I'm not going to talk too much about it because we are actually raising money for it, so we're not here to solicit tonight. But it's a 90-unit condo project in the heart of Ottawa, in kind of a hot neighborhood. So that's a project we're doing in Canada. Last item, and this is the fifth principle on raising capital, and that's alignment. And the way to think about this is it's like a pair of shoes. You've got to find that perfect fit. So I know it's been a while since you've gone into the mall and gone shopping for shoes. You probably bought it all online, but you go into the mall and you see a pair of shoes and they're gorgeous. And my God, it's your lucky day. They're on sale. But if they don't fit, you're not a buyer. It doesn't matter how beautiful they are or how deeply discounted they are. If they don't fit, you're not a buyer. And that's the mindset you need to bring to alignment. So what is the fit? The fit is, what is the size of the investment? Some investors have a $5 million minimum. If you're looking to raise 200 grand, it's not going to work. You say, well, why would someone with so much money have a $5 million minimum? Well, it's because it's not worth the paperwork. Their scarce item is time. It's not money. So they've got to use their time judiciously. What's the term of the investment? How long is the money going to be tied up for? How liquid is it? What's the rate of return? What's the tax consequence? What's the security? What's the risk? What's the control structure? And on and on and on. There's about a dozen of these. And you have to hit almost perfectly on all of them. Now, with unsophisticated investors, they're not very clear on what their investing criteria are. You'll ask them, well, what are you looking for? They say, well, I want to make money. Okay, what else? Whereas a sophisticated investor is going to be very, very clear. They know exactly what they're looking for. And you're going to get a fast no because something doesn't fit, which is really what you want. You don't want to be nurturing a discussion for weeks and months only to discover that it doesn't fit, because it's a waste of their time. It's a waste of your time. The more sophisticated the investor, you really want to hit on every single one of these. You want to get that perfect fit. So if you do all 5 of these things, develop the relationships, establish that psychological contract of trust, bring a track record to the table, have a compelling opportunity, and have that fit between the goals for the project and goals for the money, you'll find that raising money is really not that hard. Now, you're here, you're in a seminar, you're getting some knowledge. And what I've discovered along the way is that in order to accomplish anything in life, it doesn't matter what it is, absolutely you need knowledge. But if that's all it took, anyone with access to Google could take the world by storm. And so why hasn't that happened? Well, it's because it's not enough. It turns out you need 3 things. You need the knowledge, for sure. And there's people out there selling the course, selling the promise, take my course, you'll come out of the course and you're all set. And I'm sorry to say it's not enough. The next thing you need, you'll run into these folks. These are the mindset folks. They say, yeah, you've got the wrong mindset. You got to go out, get yourself some mindset. That's what you need. And that's important too, because you need that emotional fortitude. You need to be able to dig deep when it gets difficult and figure things out. But I'm sorry to say that too is not enough. And it's really this third piece that's the game changer. And this is what's transformative. You got to be immersed in the right environment. And it really is this third piece that's the game changer. So if it's been said, I think Jim Rohn said it, who you hang out with is who you become. There's many different variations on that quote. And it's absolutely true. I mean, why is it that all the elite figure skaters in the world train out of 2 rinks here in Canada? From Japan, they all train together. Why? Because they're in that environment. They compete, but they train together because they make each other better. Why? I've got a spin bike here in my basement. It's a great bike. It's a Schwinn. Why would I get in my car, drive 15 minutes to the gym, go into a room with 30 spin bikes with an instructor at the front of the room? It's not because they're going to tell me how to operate the bike. I'm going to get a better workout in that environment. It's all about environment. So it doesn't matter what you're doing. You got to get yourself in that best environment. So if you want to be a developer, hang out with developers. If you want to be an apartment investor, hang out with other apartment investors. If you're sitting behind your desk looking to Google for answers, you're not going to find them. You got to get in that environment. So how do you get good? Number 1, you got to practice. You got to get in the right environment. Ask questions of experts who do this on a daily basis. You got to attend syndication conferences. You've got to surround yourself with top-notch advisors, guys like Phil, and I have many others that I connect with on a regular basis. Maybe get a top-notch coach. Absolutely, by all means, go out and buy my book because I need the money. I don't really, but you may find it helpful. And you want to figure out who are the right folks to advise you from a securities perspective. So you definitely want to reach out to the folks at Denton's. So with that, why don't I stop there, and Elizabeth, we can open it to questions.
For sure. Absolutely. Thank you. That was amazing, guys. So I just want to ask some questions for sort of clarification. So I'm seeing a lot of deals being put together by investors right now, and they're keeping like 50% of the deal for themselves, and then they're bringing in joint venture partners, and maybe the person who qualifies for the mortgage gets 25% and the person who puts up the down payment gets 25%. So would it be reasonable to assume that, based on what you guys have said tonight, that should really probably be more of a partnership structure, where there should be the general partner who's actually finding the deal, putting the deal together, running everything together, and then there should be 2 limited partners on that for the balance of the 50%? Is that a good takeaway to have had from this evening?
Well, I think there's two questions there. One is what's the percentage split that makes sense, and the second is what's the structure. Phil, why don't you talk a little bit to the structure
Yeah,
and we can talk about the percentages.
because Kelly, Elizabeth, a couple of points you noted there. One is you said one investor is arranging the financing. Is his money intended to be more risk adverse? In other words, is he supposed to be a lender as opposed to an investor? So, in other words, his return, if things go bad, he gets repaid first, and he gets a security interest encumbering the property, while the other investor is putting up equity and not debt. If that's the case, then I would suggest that that first investor should be, a lender, either, the senior lender if he's lending all the money for the project, or possibly the junior lender if it's expected to get institutional, a senior first from a major bank, and then he tops up the second. But, presumably it's a risk reward return. So presumably his reward is less than the other investor that's in with the equity. Typically a senior and a junior mortgage are paid by way of interest return on the use of funds, for the time use of funds. Sometimes there's what's called a kicker, an equity kicker, where they get a performance kicker based on the success. But again, if the deal's been negotiated where investor one is supposed to be more risk adverse, and his reward should be less as well, there would be reason to distinguish them. Okay.
So you guys are really talking about a completely different world than most newer investors are operating in right now. Like most new investors are literally doing the JV agreement with, you qualify for the mortgage, you get 25% of the overall profits. You put up the funds, you get 25%, and I put the deal together, I get 50. And
Okay.
that's sort of the most basic structure that most of the investors probably.
Well, let me ask you this to better clarify that. So you said one investor goes out and gets the mortgage. Obviously, he's putting his covenant up. But obviously, if the deal goes astray, the mortgage, the first dollars recovered will be paid to the mortgage. So that investor who put up his guarantee is less exposed than the other investor putting up his 25%.
100%.
Is the guarantor investor getting less of a return because there's less risk? Or, again, I'm not here to negotiate the business terms of the deal, but that's something I would note right up front in terms of the distinction of the parties. And then secondly, is the promoter the promoter's putting up 50% in your example, and the passive investor is putting up the 25%. I would assume that the passive investor would get his money back as before the 50% promoter gets his money back, unless they're intended to be pro rata, which is very common because, again, if there's strong sponsorship there, if the promoter is putting up 50%. So it could go either way.
Most of the deals that I'm seeing right now people are not putting, like the 50% partner is not putting up anything. Their contribution to the entire thing is, this is my knowledge,
Sweat
this
equity,
is my network.
sweat equity.
Sweat equity, right?
We call that sweat equity. Yeah. Now, again, what we've seen in the more sophisticated deals is the sweat equity is put into like a fee basis where, I'm providing you with all the fees, my knowledge. And again, it could be paid out, in the waterfall as part of the profit pool, but not deferred. So presumably then all the capital gets repaid before the sweat equity gets paid anything. So, but just remember the distinction between investor one and investor two. If investor one is putting up his guarantee, well, the first monies received will be paid back to the mortgagee, reducing the investor guarantor's exposure automatically. Investor two, and again, they can still be limited partners for their equity contribution. It's just recognizing the difference in their commitments and the risk appetite that they're assuming.
So would it be fair to say that in most of these situations, although it's common practice for in the world of real estate investing to do the joint venture agreements, in most situations, it would actually offer better protection to all parties to do the partnership route?
Well, limited partnership, first of all, I could tell you right now, when you're dealing with strategic investors like a bank, when a bank is asked to review a deal, the bank will take comfort. And again, it's not like the bank is hardwired, but most deals they review are structured as limited partnerships that come into the bank. So if you're coming to the bank for financing, let's say your guarantor is bringing this deal to his bank to say, okay, this is the deal I want to go into. I want bank to give a first mortgage. I will guarantee it, and that's my commitment. The bank at the end of the day is looking as a lender to this project and will want to see it properly structured. A limited partnership is an easier structure for a bank to get a handle on than a co-tenancy. There's a lot more due diligence in a co-tenancy environment. It doesn't mean it can't be done. It's just more expensive.
Gotcha. Absolutely. Thank you.
Yeah, I think that's right. Let me give a small example just to make it a little bit more accessible. And I'll give you two examples because I want to illustrate the spectrum. There is no set rule that says you have to give so much percent to an investor in exchange for X. So this is a project that I did back in 2014 in Philadelphia. This is a 10-unit building. You can see that all right?
Yeah.
Okay.
It's a nice looking building.
It's a 10-unit building. It's a ground up construction. We bought the dirt for $135,000. We our all-in cost, land, hard cost, soft cost, everything was $1,050,000. We built it for $88 a square foot hard cost. It appraised on completion for $1,800,000. The bank gave us back $1,300,000. We returned the cash that we had borrowed originally as part of the construction loan. We had a construction loan for about a little over $800,000, and we had borrowed two tranches of $110,000 each. And we returned each of those investors their $110,000. Now, those particular investors wanted a rate of interest. They did not want equity. They simply wanted their money to be secure. I forget what it was. Maybe it was 10%, maybe it was 12%. I can't remember. So in that particular instance, we ended up retaining 100% ownership of this building. We gave up zero ownership.
Wow. For
that $220,000. So there's no hard and set rule that says you have to do it a certain way. We've done deals where we've given up 9%. We've done deals where we've given up 70%. For example, that 240 unit new build, this one here, South Lake Village, we're giving 70% ownership to the investors. Now, I'm giving 6% ownership to a couple of guys that are, between them have about 50 million net worth. They're co-signing on the construction loan. They also own about another 1,800 units in their portfolio. So they bring additional balance sheet that's local. See, I'm non-resident, I'm Canadian. So my signature isn't worth that much in the US. So for me to simply go do these projects on my own in the US would be very, very difficult because I'm non-resident. So I need to bring in local partners, which means also giving up equity. So there's no one way to do it. You have to figure out what's going to work for that particular deal.
Gotcha. So would it make sense for someone starting out, like let's say they're working on their first land development deal, then what, and perhaps you covered this in the book, and I'm going to be ordering a copy of the book. I am super excited to read it. I'm assuming it covers this kind of information again. So when you're starting out on a deal, what is the first thing you do? I mean, okay, you get an accepted offer on a piece of land. Like, what do you do next? Do you call Phil and go, okay, Phil, help me put this deal together. Tell me what I need to do.
We do what's called, we work backwards. We do what's called residual land value analysis. So what we do is we start from what is the finished product and what is it going to rent for? What's it going to sell for in the marketplace? So I'll take a particular apartment building and say, all right, this apartment building is going to rent for whatever it is, $3 a square foot. So you back up from that and say, what can $3 a square foot in rent deliver in terms of profit margin? And then you back up and you subtract your construction costs, you subtract your soft costs, and then what's left over is what you can afford to pay for the land. So you work backwards from the finish line. The golfers do the same thing. When Tiger Woods plays, he doesn't play from the tee to the green. He plays from the green to the tee. He says, if I want to land at this spot on the green, where does the shot before that need to land? It's always working backwards. You do the same thing. You've heard the phrase, you probably heard financial advisors say, pay yourself first. Mm-hmm. That's the same concept. Figure out what is the finish line, what does the profit need to be, and you work backwards. That's always the mindset. It doesn't matter whether you're building something for resale, something to build and hold, buy and hold, you always work backwards.
Gotcha.
So once you have that model in your head or on paper or in a spreadsheet, that you have that very clear model, then you know already what it's going to look like. Now, I guess I'm not really answering your question because I'm just saying, well, you just know, and that's not very helpful. But
in the beginning, we don't know. So,
right,
so that's
exactly.
what questions do we ask? Who do we see? Like, I guess that's kind of what I'm asking. Well, if you're a wannabe developer on our webinar tonight, then what do we do? Okay, so just hang out. We go, hey, Victor, what are you doing this week? And we come like follow along with you and be your shadow. And then we spend a week with Phil and just hang out in his office. And
well, he might charge a little more, but
yeah, you'd be bored. You'd probably run away. No, these are very good questions. But obviously, if there's an interest, there's something that you've already bring to the table that expresses that interest. I don't know if you have construction experience, you have friends and family that are interested. If you're starting out small like that, when it comes to structuring, it's give thought to these things that we've talked about now, like the risk reward. The rest we can assist you with, in arranging it. But the smaller initial deals will not be that sophisticated. There shouldn't be that many stakeholders. There shouldn't be that many issues, but there should be a strong comfort level. Going back to Victor's comment about trust is critical. The more focus is to make certain the deal works with third-party stakeholders, like, for example, the lender, the bank. If you're going to use a third-party contractor, you understand how that works. So the relationship among the stakeholders, which is the passive and active investors, is one thing. But more importantly, it's particularly in the earlier stages, is your relationships with third parties that will be involved in the development, because presumably you don't have all the experience. Like, you might be strong in construction, but you have no development experience. So you'll need a planner. The planner, you have to make certain that the planner relationship makes sense. That would be a third party contract, not unrelated contract. It should be budgeted. So, there is some hand holding. It could be, the hand holding could be done by, but it's more understanding what are the business terms between the stakeholders, and then what other third-party stakeholders will you have to deal with, and then the rest can be sorted out.
Okay, I love that, because one of the questions was, how big does a deal need to be to make the legal bill make sense? And it sounds like you're saying the smaller deals have smaller bills because they're less complicated. So really, you just surround yourself with the right people from the beginning, you learn from them, and then that enables you to climb the stairs basically, and to be able to grow as a developer.
Yeah, and again, like for example, we have junior lawyers, because the issues you're raising here don't require a senior lawyer. Frankly, my junior lawyers are trying to push me out. They're looking for the bigger ticket items all the time, and well deserved, but they're all very competent in handling these deals. So the legal fees, their billing rates are significantly less.
Gotcha.
But again, we had a small real estate agent approach, a young real estate agent approach one of our junior lawyers that they met in a social network. And the junior lawyer started to work with this real estate agent that had an idea of finding properties and has a cousin that's a contractor. Small ticket items, but they're making it work. And it's very good. In fact, this junior real estate lawyer keeps investing with these guys. I don't think he'll work for me that much longer, to be honest.
That's awesome. Yeah. Okay, so we have 3 questions here, and we have 6 minutes left. How do I want you guys to do this? Okay, so here's what I think we'll do. So the first question, we're going to go with Sid's question, and he says, I'd be grateful if Phil explained a little bit further why investors in JVs are better served and protected in a limited partnership versus, for example, in a regular corp or a Bear Trust Corp. He says, I recently joined a JV and a Bear Trust Corp. I appreciate any thoughts Phil or Victor can share on this.
So first of all, Sid, again, it's hard for me to say from the outset without having particulars as to why your deal was structured like that. Again, the concern I raise is not so much that you can't accomplish your deal, document your deal that way. It's a lot more work. A lot more involvement because you're doing everything by contract as opposed to having a statute that helps give a guidance. And more importantly, how you're able to communicate this arrangement with those third-party stakeholders, like if you're using a third-party lender as a mortgagee, because the lender is going to take security over the asset and it needs to make certain that the borrower is properly, is a proper obliger. And there's greater protection with the partnership, with the Limited Partnership Act, than just relying on a co-tenancy agreement. It can be done, so I don't want to dismiss that. It's just
more complicated.
Yeah, it's more complicated, and the better practice right now is just to go to limited partnerships.
Gotcha. Okay, thank you. That was good. Adam asked, could Victor work backwards on a deal, preferably in Ottawa, from greened to teeing off? He thinks this would be helpful for everyone.
I have one close at hand. Unfortunately, it's not Ottawa, but I'll put this one up because it's just close at hand, and I think it'll illustrate the point. What we look for in every project that we do, especially if it's a buy and hold or a build and hold, is we're looking to have an interim exit. Because if you have a sale, that sale is a taxable event. So we want to be able to create enough value in any project that we do that we can refinance and use that refinance as an exit. So a refinance typically is going to be 70-75% loan to value. So I have to cap my investment at 70-75% of its ultimate appraised value. That we go into every project with that in mind. If the project can't deliver that, we won't even start it. Now, because we want to get to that point where we can generate infinite return. We want to be able to return capital to all the investors as part of that refinance, because that's not a taxable event. They're still in the deal, but then the return goes infinite. It doesn't matter whether it's a 10-unit building or 200. The math is always the same. So we always work backwards from that as the premise. This is a simple example. This was a 9-unit project. Address is 2035 North College Avenue in Philadelphia. 25, 20, 37, 20, 39. It's a 3 triplexes side by side, 9-unit building. We bought the dirt for about $110,000. Our construction cost was a little higher. We were about $112 a square foot. We were all in at about $1.62 million. We actually just sold this. We sold the last triplex this past week, but it appraised at 2.2. And so we were able to return capital to investors. We ended up selling, I think, in the end, about 9% of this project to investors. We kept the rest ourselves. Yeah, we had one investor he was originally out of Phoenix, and then he moved to Ecuador on this particular project. But again, it doesn't matter. It's always the same. We always look for that set of market conditions where we can generate enough value. And I can go deeper into this, but we probably don't have time. But that's the basic essence of it.
Perfect. Thank you, Victor. And one last quick question. Victor, you worked in a corporate job for most of your life. How did you transition from a job mentality in 2009 to being a real estate developer in just a few years, especially leaving, a VP role, prestigious? If you could talk about the steps you took to learn that and what you would do differently if you had to start that journey today.
Well, it was in the world of technology, of tech startups in particular. And so it was already quite entrepreneurial. We had taken one company public, which was Tundra Semiconductor. I was joined there as director of engineering, was VP of engineering for a while, and then was in their technology office. And we took that company public in, I want to say 98 or 99. That was a good experience. And over the course of my career, ended up doing several mergers and acquisitions. So I really got immersed in the world of finance and of starting new things. So entrepreneurship was even what was there, even if I was not necessarily raising the capital myself. I was part of a management team that was raising capital. Part of a company in Montreal called WaveSat that eventually got sold to Cavium out of California. That's the company we were building baseband processor chips for Wilcom in Japan and for SK Telecom and numerous other telecom providers all over the world. So it was entrepreneurial. What I took from that particular environment that served me very well, people talk about real estate being hyper-local, and it is. And a lot of people are always looking what's within a 10-minute drive of their house. Well, what can I, that's the mindset. Well, in the world of tech, I was dealing with people all over the world all the time. And if you think managing construction's hard, try managing software development when you guys are in India or in Israel or in France or wherever, and you can't literally be checking up on them on a daily basis. When I was VP of engineering, I had 13 design centers around the world. So I was always in the wrong place for somebody. So when I switched into the world of real estate investing and development, it was natural for me to do something that was outside my hometown because I've been doing it all my career. I learned how to manage remotely. But that was an acquired skill. It was not a natural behavior by any means. It was a learned skill.
So it sounds like taking some of the skills that you have, right, when you're working a 9 to 5, taking those skills and really using them to accelerate into real estate, which gives you a much softer landing than just trying to start cold.
I don't want to put too rosy a picture on it. I made a ton of mistakes at the beginning. Oh, absolutely. I mean, I had some of the wrong partners. I mean, one of them was a crook. I mean, there was a bunch of projects we did in Chicago, and at the end of that, I got the investors all their money back. Myself made zero, and I said, well, shoot, that was a waste of 2 years of my life. I mean, it was painful. It was absolutely painful. I made the mistake of being able to operate at a very high level in the tech industry, and I literally got into real estate at the very bottom, started flipping houses. It was nuts. It was stupid. If I was to go back and do it over again, I would do it so differently. And go ahead.
Oh, just to Victor's point, one of the more successful limited partner promoters of limited partnerships that we work with, and again, they're at the point right now when they bring something to market, it's already oversubscribed by their existing investors. And the funny thing is, the most interesting point he made, which sorry about that, I got to figure out how to disconnect the phone. One of the most interesting points he made is early on, he said his best deals were the ones where he gained the confidence with the clients, were the ones that were poorly performed. In other words, they really respected the way he handled the bad deals, and there will be bad deals. It's transparency. It's for, there's unforeseeable issues that can come up all the time. I mean, right now, the bond market is killing everyone on residential purpose type transactions because of the long-term commitments for money. And construction costs are are all over the place, but this guy obviously he hits more than he fails. But if he doesn't meet his thresholds, his existing investors know full well that he's done everything he can, and he took pride in he took pride on his worst deal when he got his investors their last capital back from a poor deal, which was something, unforeseeable.
It takes a lot of integrity to do that.
Yeah. So there's a lot to be said for that, because these are long-term relationships.
Absolutely. And on that note, I'd like to thank both of you so much. As Sarah has said, thank you so much for sharing your knowledge so generously with us. This has been an absolute pleasure to have both of you here. We really appreciate your time. We're at the point in the webinar where I always offer people, we usually do a giveaway book. Now, Victor, I don't mean to in any way slight your book. So if you'd like to jump in and offer a copy of your book for people attending, you're welcome to. We have Cherry Chan's book this evening. Phil, could you give me a number between 1 and 60, please?
Oh, easy. 32.
32, perfect. Mary Beth will be contacting attendee number 32 in the next couple of days. We'll be sending you a copy of Cherry Chan's book as a thank you for joining us this evening. If you are not already a member of either one of my Facebook groups, we have the Canadian Real Estate Investing Mastermind, Canadian Real Estate Investment Hub. We would love to see you over there. At Mastermind, we're really focusing on growing our knowledge and supporting each other as real estate investors. If you would like to stay in touch or follow up with any of us, for example, I heard Victor was willing to open up his calendar, free reign, all kinds of access. We can just follow along with him en masse. We'll just rent a shuttle bus and follow Victor so that we can hang out with him. But I think, in all honesty, Victor, I'm assuming your podcast is probably the absolute best place to start in terms of really trying to understand what your world looks like and benefit from that.
Absolutely. Yeah, the show's we're into our 5th year. I don't know, episode 1500 and something.
Wow.
So yeah, it's a hamster wheel some days, but but it's and the idea behind the show, it's literally your morning shot of what's new in the world of real estate investing. So the weekday edition are 5 minutes, just me, and the weekend edition are interviews with notable people from the world of investing.
Fantastic. Thank you. And my next webinar is going to be Monday, April 25th. It's a lunchtime one, so it'll be 12 noon. I will be joined by Ryan Day from Calvert Home Mortgage, and we'll be diving more into the Calvert Home Mortgage financing for flippers. What do you need to know? What are the terms to qualify? How do you run your numbers? What is their underwriting and due diligence process? So we're going to kind of dive in a little bit deeper and learn more for people who are doing flipping or BRRRRs, what kind of financing is out there that doesn't require you to necessarily fall afoul of the OSC, and you can actually just go and borrow money from Calvert and then refinance with a traditional lender. Guys, it has been such an absolute pleasure. Thank you very much for your time. Thank you to everybody who attended. I hope you all enjoyed this as much as I did. You will all be sent the recording before the end of the week, and you will see it on my YouTube channel within the next 2 weeks. Thanks so much, everyone. Have a great evening. Take care. We'll talk to you all again soon.
Thank you.
Thanks, gentlemen. Bye-bye.